Well, welcome to today's call. Uh, we are going to get started. For those of you that are still signing on, which it looks like we got a few, we'll get through some of the regular stuff and hopefully everyone's on by the time I'm done with that. Today, we're talking about advanced tax strategies for managing embedded capital gains. So we're going to get into some very specific detail. I think sometimes webinars are fun if you can dig in a little bit and they're not just always talking about the general ideas. So today's a little more specific. To that extent, I'm going to remind everyone that the information we're sharing is going to be somewhat geared towards maybe harder subjects within taxes and stuff. So please make sure you talk to your CPA or financial advisor because we do want to make sure that people don't take everything we say as gospel truth. It's always unique to your circumstance. So with that, I'll get going and introduce Nate. As everyone knows, usually who's been on these presentations, I am John Meyer. I am here helping run the wealth management practice. Today we have Nate Panning joining us, who is a partner on the CPA side, and Nate basically is got a lot of knowledge in these complex topics. That's why I wanted to ask him to be on today's call. So we'll dig in with Nate, and that way, Nate, any tough questions, I'll just swing your way instead of me having to look dumb. But with that, I'm going to take the first set of slides. Nate's going to take the second set. And we'll probably intersperse if we need to within each one as we see fit. So if there are any questions along the way, as a reminder, just drop your question in the Q&A box on your screen. And if you do that during the session, I'll be sure to watch it and make sure that I can jump in as needed. Let's get started on today's agenda. From our standpoint, we're going to start with the simple idea of what's the difference between selling and not selling something, because we can diversify sometimes within our portfolios and within our lives without having some of these tax hits that we normally would see if we just went out and sold something and paid the tax. It's not always true, but today we're going to talk about the scenarios where it can be true. We're going to get into specific tools. And so the way I frame these tools, we're going to talk about tools that are meant more for deferral of gains, and then tools that are meant for permanent elimination of gains, and then tools that are meant more for just managing gains. So there's a couple of different viewpoints here, and that's what we'll get into as we go forward. I'm going to start with a simple illustration. And the reason I want to do this is just to kind of set the ground rules a little bit. So let's pretend you have an asset that's worth $1 million today that you paid around 250,000 for. So therefore you have $750,000 of capital gains built into it. If you turn around and sold that, you'd pay tax on the 750. And the tax on that 750,000, if we just assumed federal and state tax, this includes federal, because of the size of this, the federal capital gains tax would be 20% plus a 3.8% extra Medicare tax plus Minnesota state tax at the highest rate. So that's where you get this 250. Now let's take that and look at it a little differently. Let's pretend instead of you doing that, which is what this is showing, let's say you just held that asset. So in this scenario, I said, let's take that 750,000 roughly net of tax and invest it. And that's this yellow column. So you sell today, you pay your tax, you reinvested it. And over the next 30 years at 6% annual growth, it would turn into 4.3 million. But going back to the original question, let's say we never sold that asset. If we never sold it and just held it, you wouldn't have that immediate tax hit of 250,000. And so the $1 million would actually grow to 5.7 million. So that difference of $1.4 million is really that 250 grand that you paid in tax that didn't compound in growth. That's where all that difference comes from. And it's important to look at that because in the long run, I think people kind of forget sometimes. The simple approach is pay your taxes, but sometimes there are methods to get around that. And from that perspective, I took it one step further. And I basically wanted to say, well, hang on a second, 30 years down the road, you still need to, let's say you still need to sell those assets to do something and pay taxes. What does that actually look like? And in 30 years later, when you sold them after tax, the one where you just let the $1 million grow grew to 3.9 million. The one that you sold, paid the tax, and then did something else grew to 3.1 on an after-tax basis. So your net savings is still almost $800,000. So if you look at it from this perspective, that's why we're talking about what we're talking about today. And lest anyone on this call think that I'm talking about tax evasion, I want to tell a little story. This goes back a long, long time ago, but Justice Brandeis was a Supreme Court justice, and he had a big tax case in front of him. And he cited a certain way in that tax case, but the story he told, I think, was really fantastic. His perspective was every night after his hearings in the Supreme Court, he has to drive back across the Potomac Bridge to his house. And if he takes that route, he has to pay a toll because the bridge is a toll bridge. However, if he can get out of the court early in the day, sometimes he'll skip the bridge and he'll take the longer route, which takes him a few miles out of his way across a different bridge that's not a toll bridge. And he said, whether I decide to pay the toll or not pay the toll is a question of whether or not I'm looking for tax avoidance or tax evasion. Because tax evasion is I decided to take the toll bridge and not pay the toll, but tax avoidance is I decided to take the other bridge instead of paying the toll. And I think that's the part that I want to kind of hone in on today. We're not talking about ways that are just so out there that there aren't things that the IRS doesn't know about. This is all stuff today we're talking about that the IRS knows about. As long as you do things correctly, everyone's fine. And I think that's the biggest thing I want to bring from this slide. So as we get into this, I'm going to talk about some deferral opportunities, and I'm going to get into some really specific ideas. And then I'll have Nate take it after that. So from my standpoint, I want to start with three main ideas. One is exchange funds. I'm going to go through the basics of that. The second step from exchange funds is doing what's called a 351 ETF conversion, which is a similar idea. And then the third one, Section 1031, everybody who's in real estate probably knows about this, but it's another similar idea. It's just that it's specific to real estate. So let me jump into these. From a deferral standpoint, one of the ideas around that I want to throw out is this idea of an exchange fund, because basically what it allows you to do is to take a concentrated holding. Let's pretend you had $1 million worth of stock in something, and you want to diversify it because you know it's risky holding that much, but at the same time, you don't want to pay your tax right away. The way an exchange fund works is you can take that stock and transfer into the exchange fund. The fund basically then says you now own shares of this exchange, but since the stock itself wasn't sold, you don't have any capital gains issue per se. The exchange fund does have some rules. And so, in the benefits side, it's very easy to see that there's tax deferral. The diversification comes from the fact that you've got many other people, maybe hundreds of other people putting stocks in as well. And so when they do that, you get a share of the fund, which is made up of all these different stocks. And just like that, overnight, you're diversified. The drawback to that is these funds can be a little bit unwieldy. And here are the issues. A, if you want your money back, you can get your money back. But if you ask for it back before the 7-year holding period is up, which is just a defined issue, you can get it back, but they have the right to give it back to you in any way they deem fit. So basically what that means is they could give you back all the stock you put in and you really didn't get diversified. They could give you back shares of a few things, but not really overly diversified. That's the negative. If you wait the 7 years, anytime after that period, if you say, I want my money back, They then have to diversify that and basically give you back shares of a diversified group in the portfolio. So you do maintain your diversification, and since nothing was technically sold, you maintain not having to pay capital gains. You still have the same cost basis that you went into the fund with, but that is not here nor there as long as you now diversified your portfolio. The second drawback is there are higher fees. These kinds of things do carry a little higher fees. Third is illiquidity, because like I just said, you put stock in, maybe you get stock out. Trying to get cash out, which you can do, but it's actually harder. And when we've seen this, because I do have experience with this, it can take 30 days, sometimes 60 days to get cash out of these things if you want cash. So just don't look at these as quick and easy ways to get cash. And then accredited investors only in this kind of thing. So there are a bunch of rules as far as who can do this. The other thing I want to point out is they do have a rule, and I threw this on this slide as a consideration. When you get into the fund, one of the IRS rules is that you have to initially diversify 20% of the fund. And so what these fund managers will do is they'll sell a little bit of stock across the fund and buy real estate. So for the most part, you're going to have a real estate holding within the fund. It helps diversify things. But there is a little bit of upfront cost in that tax hit for the piece they do have to sell. So just know that this is not quite as clean as I'll just put it in and never have to worry about taxes, because in general there could be still a little bit along the way. Exchange funds are interesting, and while we talk about them a lot, I will say that I don't see as many people doing them because they are a bit opaque. Which brings me to a second step. And a second step is a similar idea to the exchange fund, and that is the 351 ETF conversion. Now, let me just step back for a second. Most people on this call understand what mutual funds are. It's just a pool of stocks that a fund manager buys on your behalf. We all own mutual funds probably in some way within a 401k plan or something. A second wrapper to that is what we call an ETF, or an exchange traded fund. So think of the mutual fund, except now you can, in some sense, do two things different. One is a mutual fund gets pricing once a day at 4 in the afternoon. An ETF gets pricing all day long. So every second, it's updated pricing based on what the underlying stocks are worth. But when you trade an ETF, you actually get current pricing. And so some people like ETFs for that reason. The second thing is ETFs have a conversion idea behind them, where instead of selling an underlying stock, they can trade it out to get a new stock in that they like different. And they do. They trade if you think about it, big third parties like banks or pension funds can trade stocks in and out of these things every day then and get what they need. But what that feature allows you to do is it allows the ETF to not have to pay taxes as high, because they're not selling something, creating capital gains, and therefore passing that on through to the underlying shareholder. So ETFs tend to be more efficient than mutual funds. Over the past decade, I'd say most financial advisors are using many more ETFs. Like, we're getting more and more into that world. Let's go back to that conversion idea. If you can convert shares in and out, there's an opportunity here. And the opportunity comes in this section 351, where you basically are allowed to do what I just said about the exchange fund. You can take a stock or a group of stocks and, in essence, transfer them into an ETF. The difference here, and I'm going to get into a few details, but the difference here is that unlike an exchange fund, an ETF is immediately liquid because you're on a stock exchange. So unlike a exchange fund where you got to sit for 7 years and maybe get some things back you like and some things you don't and stuff, I can get into an ETF and the next day have trading ability. And so all of a sudden I get I still get my tax deferral because I traded shares in, I didn't sell them, but now I get liquidity and diversification immediately with no lockup periods. So from the standpoint of what the benefits are to this, it's a very interesting idea. The cons to that, because there's always a downside, the downside to that is a couple of things. A, you can only transfer securities in when the ETF is first set up. So the problem here is you can't just go out and find any ETF in the world and say, I want to do this today. It's only under when they're set up for the first time that's allowed in this scenario. So there are now firms starting to do this where they're setting up a new ETF specifically for the idea of doing this. And we are working with one of them actually to look at this exact concept with clients. So if you look at it from that perspective, there are ways to do it, and that's fairly new. Like 4 or 5 years ago, that was not doable, and today it is much more. The second negative, and I throw that in the considerations box here, is no single security can make up more than 25% of the ETF. Meaning, if you put $1 million in of, let's say you had $1 million worth of a stock, you can only really put in about $250,000 of it, because if you want to put $1 million in, only 25% of it can be in one stock. And then the second part to that rule is this 50% rule, meaning the top 5 securities you put in combined cannot add up to more than 50%. So when you put these rules together, what it really means is you got to put in a bit of a diversified piece. You can't just put in one stock. But that's okay, because if you've got capital gains across your portfolio, you could find all kinds of things. A good example of this, you put in, let's say you wanted to contribute $1 million to something. You put in 250,000 of one stock, and then $750,000 of, let's say, the S&P 500 ETF or other things you have laying around. The way this works is especially if you put in other ETFs, they'll look underneath the hood and see what all the different stocks are underneath the hood. They don't look at it as just one security. And so you can look and say, okay, I got this diversified portfolio. And what we find is, on average, if you put in 11 securities, the rules tend to work out just fine. So there are some rules around it, but this is becoming an interesting way to diversify a portfolio differently. And so I want people to be more aware of it because it is a fairly new concept. With that, I'm going to keep moving. The last tool for deferral is more along the lines of real estate. It's the same concept, though. In essence, a 1031 exchange allows people with real estate to roll it from one project to the next. So it's kind of, I always joke with my friends in real estate that you're only as good as your last deal, because they keep rolling things time and time again. And for 30 or 40 years, they just never pay taxes. But on their last deal, they will, because eventually they want their cash to spend. So if you think about it, though, you can continue to do this. And what you need to do, though, is look at it from the standpoint of like-kind property, where you sell something and reinvest the proceeds in something like-kind. The first question we get all the time, and Nate'll back me up on this, is, oh, can I do this with my house? And the answer is no. Can't do this with your house. So think of it as any property you're using for business use, we can figure out ways to do other stuff, but not your personal residence. But it is a way to compound wealth. And if you look at the drawback side to this, and there's some specific drawbacks to this, you do have to identify the next project in a certain time frame. You do have to actually buy that next project within a certain time frame. So there are some specific things to do, and you've got to have a qualified intermediary. I've seen these things go wrong when people take possession of the cash thinking I'll just do a 1031 exchange and I've got a few months to worry about it. That's not doable. You have to have an intermediary. When you sell something, take the cash and sit on it, basically in an escrow account, while you go on to the next thing. So just know there are ways that this has to get done the right way. And if you don't do it the right way, it kind of blows the whole idea up. All right.
I'm going to step into this idea of step up basis on this slide in a different slide. So I'm going to skip this one and I'll bring it back. Before I jump to Nate, I'm going to talk quickly about a couple of ideas around permanent elimination. And I say this because there are ways to do this if you have other ideas in mind. And one being charitable intent. The other idea that we never like is death, but I am going to talk about it. So from our standpoint, permanent elimination can occur if you've got a lot of capital gains issues. The biggest error we see people making on a tax return usually is that they're giving stock or giving cash to charities when they could gift appreciated stock. So from our standpoint, if we give appreciated stock, you get a deduction for the full market value of whatever you're giving, but you don't have to pay the capital gains tax because you're gifting the stock. The charity doesn't pay tax, so they can sell it immediately and spend it. So it's kind of a win-win. If you really like that stock, take some cash and buy it back. That's always your option. But I bring it up because that is an issue that comes up a lot. I'll throw out there too, just I'm not going to get into it today. When I say appreciated stock, I oftentimes, or most of the time, we just say it and everyone assumes the stock market. Technically, though, this can be done with private equity shares too. So if you have a small business that you think you might sell somewhere in the near term or that kind of stuff, there are ways to do this. And so I just bring it up for people that might fall into that. Secondly, another tool is this idea of charitable remainder trust or charitable lead trust. They operate similarly, but they're technically opposite of each other. In a charitable remainder trust, you put money in, and basically the income stream out goes to you or a designated person like your children or something. But at death, whatever's left in that trust goes on to the charity. In a charitable lead trust, it's the opposite, where you put money in and the income goes to the charity, and then at your death, the money that's left goes back to your heirs. So these are kind of opposites, but they're similar in some ways in how they're operating. And I only throw them out there because technically these are doable. We don't see them used as much anymore. And I would argue that if you're going to do them, don't do them if you're not doing them with at least $1 million, because of the costs and all the things that go along with them. The third thing to throw out there, though, is the donor advised funds, and that's why charitable remainder trusts are becoming less used. I think is donor advised funds have become so efficient. Donor advised funds, basically think of it as a brokerage account where you can drop the money in like an appreciated stock, but because it's with a charity, you get your tax deduction immediately, but you don't have to give the money out right away. You can give it out over the next decade or two or whatever you want. So you have tons of time, but you get the tax deduction in the year you do this. Donor advised funds are all over the place. Everyone's got them. Schwab, Fidelity, Vanguard, Catholic Community Foundation, Jewish Foundation, everybody's got them. So you should not have a problem finding these if you want to do them. I will say across the board fees are different, so you might want to check that, but very doable. And then finally, from a permanent elimination standpoint, technically a qualified charitable distribution or QCD allows you to not pay tax. What it does is it allows us to give up to 100,000 a year out of your IRA to charity, and it never hits your tax return. So if you think about it, if your required minimum distribution were underneath that amount, we can wipe out your entire RMD if you want. But up to 100,000 is the answer. And, it's a great way for you to give money that otherwise would land on your tax return. And there's a bunch of other interesting ideas there, but I'm not going to get into because I've done this on other tax webinars. So all ideas to eliminate, and the final elimination really comes from death. And this is that step up in basis idea I had in that box earlier. When you think about it, there's a couple of things to consider, but most people go through life accumulating assets in 401k and IRAs. And I say that
is good from the standpoint of accumulation, but when it comes to decumulating, it's not as helpful because now you have these giant tax bills sometimes that you don't want. The negative two is when you die, because IRAs and 401ks, when you die, your kids, your grandkids, whoever inherits them outside of your spouse, has 10 years to pay the taxes. And so it's much more limited versus non-qualified assets. Think of your standard brokerage account. When you die, you get this second bullet point, which is step up in basis. When you die on a non-qualified asset, on the date of death, your basis steps up to that number. There's no capital gains tax owed. And so I bring this up because sometimes if we do our jobs well and you just carry portfolios for long periods of time, you get market returns. You don't have to pay a lot of taxes on this stuff. At death, you get a step up in basis so your kids and your grandkids don't pay a lot of taxes. Now, they might still pay tax on the estate tax side because the value of your estate might be that big. But from the standpoint of do they need to pay capital gains tax, the answer would be no then. And so I bring it up just as a tool because if you think about, and I hate to bring this up, but if you think about what some of the wealthier people do, like an Elon Musk, and yes, I'm using Elon Musk's name here specifically, he borrows against his portfolio as opposed to selling anything for this reason. He's borrowing his spending money in life. When he dies, whatever's borrowed will get paid back by them selling stock in his portfolio, but he'll get the step up in basis. And so his tax bill technically will be cheaper. That's what happens on the really wealthy side. And so we're just bringing that concept down a little bit to say that can work in all kinds of portfolio sizes. I'm going to finish off with a quick management tool, and then I'm going to hand it off to Nate. So when we talk about different types of products like a 351 conversion or a exchange fund or a 1031, those are very specific things that lead to, in this scenario, it works. If we step back a little bit, the concept of tax loss harvesting is a little broader. And what tax loss harvesting does is it basically says, we're going to sell losses in the portfolio to offset gains. And if you think about it, gains could be what you're dealing with that day, but gains could be something else. Gains could be that you're going to sell your business in a year or two. Gains could be selling a piece of real estate not in your portfolio or whatever. So it's not that you'll never sell something and pay capital gains, but if there's a way to mitigate that, what are the other options? So I want to bring up a tool that's different that people don't talk about a lot, but it's very interesting, and that's this idea of a 130-30. If you think about it, 130-30 is very specific because what it does is and this is going to get a little confusing. Instead of just buying, as an example, an index like the S&P 500, where you just take $1,000 and buy $1,000 of the S&P, what it would do is it would actually say, let's do something a little different where we leverage that. And then what it's going to do is it's going to take and buy 130%. So instead of buying $1,000 of the S&P, it would buy $1,300 of the S&P. But it only wants to be, own the stocks on 100% exposure, not 130% exposure. So what it does then is they go back in and they short, or if you think about shorting, what they're doing is they're selling shares that they believe are going to drop in value. So they sell them at today's price and they hope to buy them back in the future at a lower price to replenish them. And they short 30%. So if you go long 130 and you're short 30, your net exposure is the 100% that you wanted. But if you think about what really is happening under the hood, by going 30% to the high side and 30% to the low side, you're wrong on something there. You're wrong. And where you're wrong is either the market goes up or the market goes down, right? And whatever direction it goes, the other side of that trade's wrong. So you just sell it and take your losses. And now you have losses to offset gains elsewhere. It's a simple way of saying it because it's a little more convoluted than that, but that's kind of how you got to think about it. And so what you're really doing if you do that is you're eking out hopefully a few percentage points more return by having these losses that you can use to offset gains elsewhere. It's kind of a hard concept to explain cleanly, but it is doable. And when I say that, I also want to say that you can do this in any market. You can do it here in the US in large companies or small companies, but you could do it in European markets or you could do it in emerging markets. So you can actually diversify your portfolio across a lot of different markets fairly well and do something that's fairly unique in creating capital gains. Um, I'm not going to get into more detail than that. If anyone really wants to, I'm happy to talk more, offline if people want to send an email or something. But with that, I'm going to hand it off to Nate, and Nate gets to jump into the really fun stuff. Let's start with opportunity zones.
Yeah, I thought all your stuff was the fun stuff.
I know.
Got the gears grinding and moving, that's for sure. So first we'll start with one deferral mechanism. There's only 1 year left of this one. It started back in 2018. The goal was to get more money pumped into low income areas, and there was also other areas that were specific that each governor could pick. So like in Minnesota, like the Mall of America, that's not a low income neighborhood. It's just an area they want to develop. Our office is right by it, and you can just see a ton of development right along the light rail. So that's another place along the light rail throughout the Twin Cities. You'll see that it was qualified as a zone that would qualify for this deferral. I say 1 year because at the end of 2026, any investments in here any gains that you've deferred and put into this fund, it's triggered on December 31st, 2026. So if you do it in 2025, you can at least get a year deferral, and then April 15th, 2027 is when you're going to have to pay the tax on that. Another piece of this would be that if you really think this investment's going to go up, if you hold it for 10 years, any growth above what you've put in and recognized gain on, or any extra on top of that, if you hold it for 10 years, that appreciation on top of your investment will be tax-free when you do sell it. The only thing is that you got to take the risk and you got to hold it for 10 years. Maybe the property won't cash flow, who knows? But it is an opportunity out there. Like I said, the zip codes that qualify for these zones are usually 400% of the property level. So that plus all these special zones that I mentioned earlier. John, you want to go to the trust slide? So I'm going to do top level on these trusts because they can get very complicated. And some of them I think of them as games. If you like to gamble, some of them are kind of a gamble. Like I think I'm going to beat this rate. So when I mention the rate, there's an IRS rate, this section 7520. So it tells you have to be either no higher or no lower than this rate. So right now that rate is 5%. So for this first one, the grantor retain annuity trust, the goal there is to put assets that you think are going to quickly appreciate over a certain period of time. So I'll use an example. So let's say someone set up a 5-year GRAT. The rate is 5%. They put $1 million in. So we use a 5% present value. That means they'll get about 1.15 million over the next 5 years equally. The point of that is you use 5%. That way you basically have a net zero gift because you're going to get all that expected appreciation based on that 5% rate back. If those assets beat 5%, that upside gets to go to your heirs or whoever you're gifting to, and it does not hit your gift tax return. It goes to them gift tax free. It's not in your estate anymore. And that's kind of the upside. It's if you got the pre-IPO stock, if you've got privately held stock that you know is going to jump in value or anything like that, those are the type of assets to put in here. If you die during the period that you pick for the trust, it's just all included in your estate. You've missed the mark. I mean, it's just the risk you have to take. So you wouldn't set up a 50-year grad. You would be more controlling on that. And then if your return is less, it just comes back to you and it's included in your estate. That's just the risk you take. Since we're still on that rate, I'm just going to drop down the last one, the charitable remainder trust. The point of this is to, one, give to charity. Two, you could also get a charitable deduction out of it. So in this case, the higher rate is better. With a GRAT, the higher rate is low, is not as, you don't want that because you have a higher mark to beat to give the most with the GRAT. With a charitable remainder trust, so let's say you put $1 million in, it's a 20-year life of the trust. So it's going to pay you an income stream for 20 years. You're going to do a time value of money for that $1 million 20 years later at 5%. It's going to say that's really worth $740,000 right now. So you get a charitable deduction of $260 in the current, and then you're going to get a revenue stream for the next 20 years. And then whatever's left at the end of the 20 years will go to the charity. The rule of these is that at least 10% of the initial amount needs to go to charity for it to work properly. So it's, again, it's another game to get a current deduction and then also give to charity and keep a revenue stream. And that revenue stream can go to you, it can go to heirs, whoever it may be. It's going to be taxable to them, but it's a way to keep on getting the income stream from these assets, and then also taking advantage of the charitable giving and the deduction. And then in the middle, we've got two types of different trusts. So a SLAT or a spousal limited access trust. I see these a lot lately with possibly the estate tax exemption dropping after 2025. It's very possible with the big beautiful bill that it jumps back up or stays the same. But we've just, if couples have enough wealth, they're basically gifting the max into their spouse's trust that they've set up, and the spouse is gifting to their trust. And usually it's liquid assets or marketable securities that can be traded easily. Because the point of it is you're using up your exemption for the estate tax, plus, if needed, your spouse or yourself, if two trusts were set up, can use those assets if needed. So it helps you maintain your lifestyle, your normal day-to-day. So if you normally get a limo and that drives you around every day, that's part of your day-to-day. So assets can be used for that purpose to pull from there. If it's a large purchase that's out of the ordinary, that wouldn't fall into this maintenance, lifetime maintenance. Another piece of this is that usually it's called a defective grantor trust. So on purpose, it is going to be taxed on your tax return. But there's also a component of you're paying tax on this. These assets are eventually going to be gifted to the ultimate beneficiary. So the initial investment into it, or the contribution to the trust, that hits your gift tax return. But the tax that you pay on these assets, your beneficiaries don't have to pay tax on it. you're paying the tax as well. That's kind of a gift on top of the gift that you gave, because it's coming out of your other funds. So if you do this, you got to make sure that you have the cash to cover the taxable income that flows from these slats. But it's a great tool if you do have that excess ability to pay the tax on these assets. So that's a slat, and then the dynasty trust mentioned here. This is more so you want the wealth to go from generation to generation to generation. That's the ultimate goal. There's a lot of times where money will go from one generation into the next, and then it's gone, it's been spent, or who knows what happens to it. It's just, it wasn't managed properly. With a dynasty trust, you can have the trustee manage it. You're going to come up with a set distribution possibly every year, depending on what type of income flows through. Usually I see closely held family companies put into these, and then as it continues to grow, you got the private equities, you've got all sorts of different investments that will help create the cash flow that can be sent out each year. And I've seen one for each generation. And it's a way for those, if you get it big enough, it's a way to get into accredited investor type investments as well. But it's a good way to keep the money in the family and have it a little bit more controlled, so that it's just not shot out to the beneficiaries at the end of one's life, which can have, bad consequences if people spend all the money and just make the wrong decisions. So there are options out there for that, and it costs a little bit more to maintain, but it's well worth it if the wealth is there if you want to have that kind of feeling of control, and you know that someone is taking care of the family and not letting them just spoil their riches. And there are additional trusts out there that we haven't mentioned. They're a little bit even more complicated than these and take a lot more to maintain. But these on here are more so set. They're kind of annuities that stay the same. You can't put any more assets into them for the grats and the crats. But there's also ones, they're gruts and cruts, where it changes every single year, and it adds too many layers, and you don't see very much of them anymore. All right, John, let's hop to family-owned entity structures. So the family limited partnership, see a lot of family-owned businesses in these, and it's a good way to get the next generation in and start using discounts every year. Usually any highly quickly appreciating assets or family businesses or real estate are great assets to put into these family limited partnerships. It starts with, let's say, the parents. The parents put the assets in there, and the kids, they contribute a little bit and get their first ownership percentage of the LP. And then over time, you start gifting your interest to the kids. And the point of that is you can get valuation discounts, because the ownership is not, they're going to have lack of control of the partnership, and they're also going to have a lack of marketability. No one's going to want to come in and say, yeah, I'll buy this. I have no control of this asset. I'll buy this, but at a discounted price. So it's a good way to get highly appreciated assets into the hands of the next generation at a discount. Eventually they will get the ultimate value, but if you can gift it for a much lower value than it actually is, it's well worth it. I would say you wouldn't put a bunch of cash in here, because that's going to be tough to put a valuation discount on cash, because that's liquid. We know exactly what it costs, and you can easily move, whereas a private company is going to have a different valuation, and there's the control issues. Same thing with marketable securities. It's readily tradable. You know what the value is every single day. So those aren't the types of assets you put in there. IRAs you don't put in there, because those are attached to specific beneficiaries and can't be owned by these LPs. Another piece, the third bullet, the step up opportunity, if the kids want to buy more of the assets or buy more interests, they get this, it's called a 754 election. So whatever the value of, let's say, the real estate is at that time, they can buy it. They're buying that share of that real estate, so they can bump it up and possibly even get bonus depreciation on that portion of the building, let's say, which would be another tax benefit. Right now, they're going to move back to 100% bonus depreciation. So if you get a cost segregation study on your building, you get a big opportunity for quick deductions on there, depending on what you do. But it's a good way to shift income assets to or wealth to the next generation. And it also is a way to keep the family together if that's your ultimate goal. I know families have tried private foundations to do that. Sometimes that doesn't work the way you want it, just because views differ as time goes on, and the charitable piece doesn't seem as charitable when you're fighting with your siblings. But there is something about this where, you know, either the parents or someone they trust is running the family partnership and still talking through things, and they're working together for the same goal. And then the last piece there, the IRS 2036 inclusion issues, that's being overly aggressive, let's say trying to add a discount to cash. They're going to disallow that if they ever come and look at it. They're going to say, no, the full gift is the value of the cash. Usually, unless, you know, it's a currency that's greatly dropped in value, it's dollar for dollar usually. All right, John, let's hop to the next one. So strategies with these different items. So paying capital gains versus maybe holding an asset until you pass away, or different viewpoints on that. One viewpoint would be gifting highly appreciated stock to, say, your kids that are in a lower tax bracket, if you know they're in a lower tax bracket. The capital gains rate doesn't start until I think around 85,000. So it's possible you could be gifting and avoiding capital gains tax depending on, you know, other income that they may have. Obviously, they'd have to share, you know, what kind of income they have, and sometimes, you know, parents and children don't share that type of information, but it's a good opportunity to do that. If you know you're not going to have a taxable estate because it's below the lifetime exemption, then I would say holding the assets until death to get a step up in basis would be a good strategy. That way, when the heirs get it, and if they need to sell it right away, they're selling it for pretty much the same as the basis that it was stepped up to, the fair market value upon death, unless it's appreciated greatly in a short period of time. And then if you have anything that's highly appreciated with low basis, gifting that to charities, that would be a good candidate for that. That way, I would say don't sell it and then give to charity, give it directly to the charity. That way you don't have to pick up capital gains and you get the full fair market value. There are some limitations to, you know, how much you can deduct in 1 year if you do donate a lot, but it's well worth it, better than selling and picking up capital gains. Other pieces, so these low growth, high basis assets for step up, you want to liquidate those first, I would say. Use that high basis, sell that lot that you know is higher basis, gift those assets, use your annual exclusion every year, 18,000 per person right now. So you can gift those That way, the higher basis goes to the people you're gifting to, and you don't have to recognize gain. And it's a good gift to, give value to them, and it's also high basis, so they don't have to pick up gain. And then those type of assets are ideal for grantor trusts that are just going to be on your personal return in the long run. Whereas the low basis items might more so be ideal for gifting, putting into trusts, and giving to charity. All right, let's go to residency. So residency planning. California, by far the highest. If you're above $1 million, you're at 13.3% in the tax bracket. New York's about 10.3, but if you're in New York City, you're closer to 14% because New York City has its own income tax. I mean, it is a massive city. It's got more people in it than a lot of states, but it is very highly taxed. Other high ones would be Hawaii. That's 11%, and Minnesota's right up there at 9.85. And Minnesota just added another 1% if you have over $1 million in investment income during 1 year. So that 9.85 turns into 10.85 if you have that much investment income coming through in a single given year. So Minnesota is getting up there, top 5. So it's this residency planning comes into play if it is an option. And where I see it the most would be, let's say the family company is in talks to sell, and you live in Minnesota. You really would like to move to a non-taxable state like Florida, Texas. There are 11 total. So Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, and Wyoming. Those are all no income tax states. That doesn't mean their property taxes aren't high or sales tax are not high, but just want to throw those out there. So let's say the company is going to be sold in the next year or two. You want to move to Florida. Move to Florida before your family's S corporation sells or family's corporation sells. That way you can avoid that 10.85% tax in Minnesota. You still have the federal piece, but you can avoid that state piece by moving to another state. I've seen some move from, California to Lake Tahoe on the Nevada side. Make sure that the timing is much, much longer than just like 30 days from the closing, because that'll be a little questionable. But when this does happen, Minnesota is a little bit more aggressive. They're gonna, if they get interested, they're gonna make sure that you have established yourself in this other state. Do you have your license there? Do you have your doctors there, dentists there? Do you have your normal everyday contacts in that state? Or is your life still in Minnesota? I mean, are you still coming back constantly to see the family? Are all your doctors up here? Is your another business up here? What connections do you still have in Minnesota? If they're significant and you spend a lot of time up here. So I would say if you move out of state, you need to stay out of Minnesota for 183 days. But there's also the caveat, you need to be in that new state the most. If you travel a lot, you need to be in that state the most. So that 182 days in Minnesota thing wouldn't apply. You would have to be much less because you want to just work the percentages and be there. But this can get a lot deeper, so I won't go any deeper right now. But the selling of a business, and then if you have highly appreciated stock that you're going to sell soon, maybe just got a lot of options and the price has gone up, waiting until you've moved to that other state and established your residency there is the ideal move. So you can easily just avoid that state tax hit. Even if you move to, say, Colorado, that's easily half of half the rate of Minnesota. So you're still winning there. So usually those are the two types of transactions I've been seeing. If you sell real estate that's in Minnesota, it's going to go back to Minnesota. That's Minnesota based. But if you're selling stock, the the income tax nexus for your stock is sourced to your residency state. With partnerships, that's a little different. They're going to look at where does the partnership do business, but with S Corp stock and C Corp stock, they're going to look at your residency. So just keep that in mind. And that's all I have on residency, John. And what's the best strategy? The best strategy is all of these different things, and also working with your different advisors. Make sure that your tax advisor, your financial advisor, and your attorney are all on the same team. It should be a team approach because there are a lot of moving parts, and we don't want to send information to the tax preparer saying, "Oh, we did some tax planning back in the middle of June." Maybe it doesn't coincide with what you're actually seeing as a tax preparer. And it's like, oh, I wish we would have talked about this. I would have said this back in June so that they would have gotten a better result. So team approach is definitely the best, especially when we're getting more and more complicated with these different types of vehicles to defer gains and to move wealth around.
Yeah, since this is our final slide for those of you that want to throw questions in, I was going to say about what you said there. When we talk about strategies, I think everyone thinks you got to pick one, and what we see is 2, 3, 4, 6, 8 of them all at once sometimes make the most sense. You can get a much better spot long term by pairing them, especially with certain things where you use charitable to pair with other things that generate income. So just keep that in mind as you get going on this stuff. We do have one question that popped in. The question basically goes back to the very first slides I did. And it basically is asking, in the example of deferring tax liability for 30 years, what are recommendations around Roth conversions? Do you pay up front or let the tax dollars work for the future inside an IRA? And this question is can get a little bit specific to the individual tax return, but in general, Roth conversions work the best when you are going to pay the taxes on that conversion at a lower rate than what you expect to pay down the road. If you pay the same rate, if you're going to be in the 22% bracket now and in retirement, the answer is there is no numerical benefit to you. But if you're going to pay lower today and higher in the future, it makes sense. If you're going to pay higher today versus lower in the future, it probably doesn't make sense. And I say probably because here's the caveat. If I have the stock market drop a huge amount, let's say 30 or 40%, and I could do a Roth conversion in that market, knowing I still got to pay at a higher rate, I would consider it heavily. And the reason being is because once the stock market bounces back over the next couple of years, all that bounce back is tax-free in a Roth. And so, and I think about it from that perspective, I might say, yeah, I'm paying at a higher rate, but it's such depressed values that it makes total sense to let that happen. And I think that's where there could be some planning between, in my case, I'm a financial advisor, and Nate's case is a CPA, and adding an attorney. If you got everyone talking in the same room, you actually might come up with some really interesting ideas like that. So that's where I land on the Roth side. But if there's future questions on that, feel free to reach out. I don't know if you have anything to add, Nate.
No, same thing that I usually say is like, okay, well, how much do you have in your qualified accounts right now? Let's try and model this out and see what rate you're going to be in the long run, and then we'll figure out if it makes sense to do a Roth conversion based on the current year. So, and using that teamwork, working with a financial advisor and doing a tax projection.
Yep. I will say there are times where you talk about teamwork. I think that's the biggest issue that we see lacking in a lot of people walking in the door. Because there's so many things that can occur in one side that don't get seen by the other side. But when they're talked about, then it's like, oh my gosh. And let's go back to that Roth conversion idea. You could have certain losses on your tax return this year that a Roth conversion could fit in real nicely and you might not pay a lot of new tax. But if you don't talk to both sides, to the accountant, it looks like, great, I got some losses. And to the advisor, it's like, I missed out on an opportunity, right? I mean, there could be, that's this kind of stuff that comes up. So I just want to make sure everyone's talking to everyone all at once. That's the best answer. I don't see any other questions. So with that, join us in a month, if you'd like, for our next webinar on the changing world of investments. We're going to get into a little more detail about some of the more nuanced things that people are doing these days versus the standard. So feel free to listen into that, and hopefully I will see you then. If you do have questions after this, feel free to reach out by email, or if you want to contact any of us, you can use the phone as well. Thanks for joining us, and Nate, thank you for joining us as well.
It was a pleasure. Thank you.
All right, everyone, have a great day. Bye-bye.